Hello there everyone, today's video is all about EMI share options, enterprise management incentive options. So what are they? Why would you choose to have them? Well, basically EMI options are a form of share option, and a share option is an agreement that says members of staff have the option to acquire shares in your company. You're the business owner. Your staff can acquire shares at some stage in the future. Now, in terms of when do they acquire them, it's normally based on performance criteria. You could say they could get a tranche every year for the next so many years, depending on their performance. Or what typically tends to happen is that you design these share schemes around when the business is sold, so that they actually become shareholders on the day of the sale and they get a nice uplift in value. So let me explain how these things work. But commercially, why you would choose to do this is because it motivates and incentivizes key employees. You don't have to offer them to everyone, just people that you really rate in your business or you'd like to hang on to as a bit of a sweetener. Because basically what it is that they buy equity at some point in the future, but they buy it on the cheap. So they make, in many cases, a decent profit when they buy their shares, or what we call exercise their option, and then they sell out those shares and they've made a few quid. So let's take an example of how this actually works. So let's say you are the director shareholder of a widget making company, and you have a key member of staff, and you go to this member of staff and you say, look, we really want to hang on to you. We really rate you as a manager, and we'd like you to stay longer term. And as an incentive, you're dangling a carrot here. You say, look, we are going to give you a share option under the EMI rules, which basically says you have the option to acquire 5% of the business when we sell the business, hopefully within the next 5 years. So what actually happens is you have to put a value on your business today. So you'd get an accountant, someone like myself, to value the business. So let's say your whole business is worth £1 million today, and you set up this option agreement for the key member of staff for them to acquire 5% of this when you sell. So you have to value it. You say, right, it's valued for £1 million. But then what you need to do is value the 5% share. So 5% of £1 million, £50,000. However, when you're looking at minority shareholdings in isolation, you apply a significant discount factor to the prorated amount. Because what can you do with 5%? You can't do anything in terms of controlling the business, having a say in the business, everything else. There is no intrinsic value at 5% in isolation. So HMRC are comfortable with you applying a heavy discount to the prorated amount. So in this case, 5% pro rata would be 50 grand, but actually you can say really that's worth about £10,000. So that £10,000, and what we do is you would write to HMRC, you get full agreement to say, right, we agree that a 5% share in isolation is worth 10 grand. Fine. And essentially that is the buy-in price for the employee down the line. So when they exercise their option, they will have to shell out 10 grand to get 5% of the business. Now, like I said, what tends to happen is they buy in and sell on exactly the same day. So let's say that buy-in occurs in 5 years' time when the business is sold. So let's have a look at the maths then. So 5 years' time, key employee still around, hasn't forfeited any terms of the option agreement. Because remember, this is a legally binding agreement signed 5 years ago that says if you keep your nose clean, stick around, hit your targets, you're going to get 5% at this cheap rate. So comes to sale day, business has been sold, the employee exercises his option, 5%. It only cost him £10,000. Now, on that day, the whole business is sold. And let's say it's got up in value. Remember, we value the whole thing at £1 million on day one. 5 years hence, let's say it's worth 5 million. So, of course, on that day, the employee does get 5 million pro rata. You're not discounting anything to come up with a valuation for EMI option purposes like you did 5 years before. This is literally, you own 5%, it's cost you 10 grand, but you are going to get the full 5% of the sales price. So in other words, the employee buys in for 10 grand on sale day, but they get £250,000 in proceeds. So they get 5% of 5 million, 250 grand. It's cost them 10,000. So that's a simultaneous buy and sell on the same day. They net 240 grand. And that's fantastic. So that's the whole point of the incentive, is to say to these key individuals, look, ride this thing with me, help in the success, the growth of the business, and we'll all cash in together at the back end. And even on 5% in this example, they could make a serious chunk of change. Now, it's better than that. So that not only are they getting this hopefully this big gain, but the tax implications around all this are really favourable. So normally, if you were going to get entrepreneurs relief, or business asset disposal relief as it's been changed to what we all lovingly know it as entrepreneurs relief, you have to have held shares for a 2-year period. And that's one of the conditions to get entrepreneurs relief, the 10% rate of capital gains tax, as opposed to 20% default rate. Own the shares for 2 years. Now, in this case, the guy's owned it for 2 minutes. He bought in, sold out on the same day. However, HMRC say, that's okay. We're still going to give you the entrepreneurs relief as long as the option period has been more than 2 years. So in other words, I talked about selling 5 years after entering the option agreement. Had that have been anything less than 2 years, then that would have denied the entrepreneur's relief. But it's all about the period that you held the option, not held the shares. In this particular instance, where normally it would be the length that you've held the actual shares. So that's great. That's a nice break from HMRC there. So most of these EMI options would qualify, because I would suggest that when you look at the stats on these, most of them are exercised after 2 years of being granted. Terrific for the employee. Again, tax favorable tax treatment on the entrepreneur's relief there. And for the company gets an extra tax deduction in that year for the difference between what the employee buys in and what the value is. So in that example, that would be the 240 grand. The 240 grand that the employee clears before tax, the company gets tax relief on that amount as well, so reduces the corporation tax. Which is great. So it's a win-win situation. The company wins because it's getting lower tax. It's getting a motivated employee for those 5 years, which help grow the business. The shareholder's happy because he's selling out and he's getting, yes, he might have had to give 5% away on the cheap, but the guy who he's given it to has helped him grow, and he's trousering 95% of the uplift. So everyone's a winner in the EMI game. Now, certain conditions, like you'd expect with anything tax favourable from HMRC, in terms of size of the business, can't have an asset size in excess of about 30 million, so you don't see these things in PLCs. But certainly SMEs, small, medium-sized entities, EMI is very common. In terms of stipulation on working requirements, the staff have to be engaged for a certain period of time. Doesn't apply to various part-time employees, but I guess that's kind of the point. Anyway, you want someone who's full-time, motivated, going to help you grow that business. Typically, your right-hand man, your right-hand woman, who you really need to help you get to where you want to go. Get them some share options. And the what is the kind of the comforting thing for the employee is it's actually a legally binding agreement. So on day one, you would sign a legal agreement that says, subject to this, this, and this happening, you will be able to buy in for that price that's been agreed with HMRC. So it's not just like a handshake which says, well, when we sell, pay me this and I'll give you that. It's all legal agreement, everything else. But there are protections for the employer, of course, as well, that if you have a badly performing employee, so let's say your right-hand man all of a sudden went off AWOL and he just lost the plot, then there are things built into these option agreements to protect the employer, to say, look, you don't have to honour this because he's forfeited the conditions of the option agreement before it gets to exercising those options and him buying in on the cheap, as it were. So a really good all-around commercial as well as tax saving idea for motivating key individuals that you want to retain in your business, key employees to help you grow the business. And then they can have a payday at the end, but it doesn't have to be at the end. Like I said, you can design these any which way you want. You could say, in this particular case, I've just given the example of 5% at the back end when you sell. You could say to the same person, you get a 1% after year one. Keep your nose clean, keep driving forward, another 1% year 2, 1% year 3, and so on, so that they've built up 5% after 5 years. You don't even have to have sold the company. But of course, in that scenario, there would be the employee would have to fork out the money, because in the example of when you sell out, it's buy and sell at the same time. But of course, if you're saying to someone, look, you're going to give you these options after 1 year, then the employee would have to find that money to buy in, because there's no sale. Of course, at each year, you only sell once when you sell the whole business. So that's why they tend to be more common. But often you will, like I said, you will get such good deals in terms of valuations from HMRC because a minority interest is worth very little. So even in this example, so what was the example? We said that 5% was worth 10 grand for the buy-in price. So let's say you did it 1% a year for the next 5 years. So that is only 2 grand a year. So the employee might be happy with that. So look, I'll find 2 grand a year to pay you to buy 1% of equity each year, knowing again the same maths at the back end when ultimately they sell, they're going to get $250,000. It's just that they haven't bought in and sold at the same date. They've bought in on the drip over 5 years and then sold out later on. So even when there is actual cash outlay, it can be minimal based on those minority shareholdings. So do have a think about EMI share options, particularly if you have 1 or 2 or a few key members of staff who you could really do with hanging on to, who you know will help you drive the business. Give them that carrot, give them that motivation of saying, look, there's some equity in it for you if you play your cards right, and it's a win-win situation. So if you like this video, please do subscribe right there, and I will see you soon.